Hey there, everyone. Welcome back to our channel. If you're new here, I'm your name, and today we're diving into a topic that many of us ponder as we think about our future, retirement planning. Specifically, we're going to explore the 4% rule. Whether you're just starting your career or nearing retirement, understanding this rule can be a game changer for your financial planning. So let's get started. Have you ever wondered how much money you can safely withdraw from your retirement savings each year without running out of money? This is where the 4% rule comes into play. The 4% rule is a guideline that helps retirees determine how much they can withdraw from their retirement savings each year. It suggests that you can withdraw 4% of your initial retirement portfolio annually, adjusted for inflation, without depleting your savings over a typical 30-year retirement. Sounds simple, right? But let's break it down further with some examples. Let's say you've saved $1 million for retirement. According to the 4% rule, you could withdraw $40,000 in your first year of retirement. This amount would then be adjusted for inflation in the following years. So, if inflation is 2%, in your second year, you would withdraw $40,800 and so on. But why 4%? This figure comes from historical data analyzing stock market returns, bond yields, and inflation rates. Researchers studied many portfolios over several decades and found that a 4% withdrawal rate had a high success rate of sustaining funds for 30 years, even during market downturns. However, it's essential to note that this rule is not one size fits all. Several factors can affect how much you should withdraw. First, let's talk about market performance. If you retire during a market downturn, your investments may not perform as well as expected. This could necessitate a lower withdrawal rate to ensure your funds last. On the flip side, if the market performs exceptionally well, you might be able to withdraw more than 4%. Next, consider your longevity. If you retire at 65 and live until 95, you'll need your savings to last 30 years. But if you retire earlier or have health issues, your needs may differ. The 4% rule assumes a 30-year retirement, so adjust your strategy based on your situation. Then there's your spending habits. The 4% rule is based on averages, but everyone's lifestyle is different. Some people may spend more in their early years of retirement while traveling or enjoying new hobbies, then scale back later. In this case, a flexible withdrawal strategy might suit you better. Lastly, inflation is a critical factor. The cost of living tends to rise over time, and your withdrawals need to keep pace. That's why the 4% rule suggests adjusting your withdrawals annually based on inflation rates. If inflation spikes, you might need to rethink your withdrawal strategy. Now let's look at some data. A study by financial experts found that a portfolio with a mix of 60% stocks and 40% bonds historically supported a 4% withdrawal rate 90% of the time over a 30-year period. But if you shifted that mix to a more conservative approach, say 40% stocks and 60% bonds, your success rate dropped significantly. So, the 4% rule is a great starting point for retirement planning, but it's crucial to consider your unique circumstances. Adjust for market conditions, your longevity, lifestyle, and inflation to create a sustainable withdrawal strategy. In summary, the 4% rule provides a helpful framework for your retirement planning, guiding you on how much you can safely withdraw from your savings. However, remember, it's essential to personalize this rule to fit your financial situation. Retirement planning isn't just a set-it-and-forget-it process. It requires ongoing adjustments as life changes. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more financial insights. Have questions or experiences with the 4% rule? Share them in the comments below. We'd love to hear from you. Until next time, take care and happy planning for your future.